Today we're taking a look at the euro because it's back at its 15-year trend line. And then we're going to move on to what Bill Ackman of Pershing Square has said, the massive hedge fund, which is that he reckons the Fed are going to cut in Q1 and not in the middle of the year. And then the trading takeout today is going to be why you always need to pay attention to where the pain trade might be. Look, there's only one way that you can keep up with everything that I'm talking about each day. So make sure you click subscribe, like this video so that I pop up more and more in your YouTube videos so that you can keep your trading edge. So I've definitely highlighted this one a couple of times now. And I think, the initial direction where I believed that the price would start collapsing through here was probably wrong. The timing was probably wrong. I didn't necessarily see the dollar weakness that was inbound. But I think this is where we really start to see a reversion. Today, for example, German inflation of some of the states, the German states, came in weaker again. Shows that there's big disinflationary forces, and this is going to weigh definitely on Eurozone. I guess the Eurozone hiking, interest rate cycle, I think that this is going to induce some, pressure on yields, and so that means that bonds should tick up. There's been a big flow into German bonds as well. Which is indicative of yields coming down too. So people are betting on lower rates. But the big key thing for me is this area of the trend line. Even if you were to have sold around here, I think the risk to reward is still very much in your favor as long as you're not over leveraged on it to the downside. My perspective is always mid to long term. So you've got to pay that in mind. I know someone on YouTube said that I believe they said that they got caught out on a euro trade that I don't call trades. I call the direction with regards to how the macro looks. So please don't take the kind of topic area of what I'm talking about as being indicative of when you should enter or exit. This isn't what we're doing here. I'm just giving the background conditions and then trying to give you something to think about yourselves as part of your own process. But, all of this here is very much signifying that the US rate hike cycle is over. And now what we're going to look at is what the ruins look like effectively. How does Europe look in relation to the US? And this is now where I think that we start getting reversion the other way, where we see a really quick cutting cycle, and then the relative speed of that determines the direction of the currency pairs. So right now, every time that the euro has headed up to this trend line here, it's kind of come off. Okay, it's never reached its prior cycle high either. So you could look at this as even being the short-term high. And saying, okay, well, around this area is good to sell at. The overall direction for the euro structurally is lower, though. It can't be anything other than lower. And that is based off of the fact that they're going to need to stimulate the economy now with a weaker euro to help Germany. Germany is in the gutter, and that is pretty much the only thing that can help it right now. So, yeah, the overall direction here for the euro is certainly lower. We're going to get onto in the trading takeout what I meant by pain trade. It's definitely something to pay attention to and something that's definitely happened here. So yes, Bill Ackman, the hedge fund manager at Pershing Square, says the Fed will cut interest rates as soon as the first quarter. And this kind of matches with his closing of his short treasury position just, I think, last month in October. I think it was. And he's basically saying that he thinks that if they don't do this, that the economy will crater really, really quickly, which I can kind of see because of more global issues. If we look at other nations, Europe, for example, demand is cratering there. China's pretty messed up. Japan also has negative GDP growth. And so there are, real issues out there. But specifically what he says is what's happening is the real rate of interest, which is what impacts the economy, keeps increasing as inflation declines. So he's effectively saying that they need to lower interest rates in line with inflation here. So basically the real rate needs to be zero, is effectively what he's saying, or at least not increasing, right? And so I think it's a very prudent thing to say as a hedge fund manager, because ideally you want your stocks to go up. And if the real rate of interest is lower, it means that stocks are more likely to increase in value. But at the same time, the reason why the Fed might choose to cut, as I always say, is down to bad economic data. And they want to keep their credibility. So you're fighting here a guy who wants interest rates cut because stocks will go up faster, versus the Fed, who doesn't necessarily in quotes here, care about the stock market going up, and is looking to retain its credibility by inflation targeting. So it kind of doesn't really matter what he has to say there, but it's indicative of a broader picture of him cutting off his treasury position and him basically putting his money where his mouth is. Is that the right phrase? I think so, yeah. Put his money where his mouth is by closing that position and then coming out and saying, look, he thinks the Fed are going to cut during Q1. So it's ballsy. I like it. And it matches with his actions, which is good. And so, yeah, there's always the chance that this occurs purely based off of the speed at which data can decline. It can decline very, very rapidly. And then you get into a real panic mode. So I would definitely be watching over the start of the year as to what happens with data. Because if you recall in 2018, for example, there were volatility strategies that blew up in 2020. That's when COVID hit. So there tends to be volatility spikes in Q1 of each year. So pay attention. Pay attention to the data. Pay attention to the rate of change. And I'll be here to help you with that as well. So today's trading takeout is with regards to pain trades. Now, pain trades are quite interesting phenomenons because they don't always happen, but you can always spot them after the fact. Now, a big pain trade over the last 2 years has been the short bond trade, or if you want to put it into the context of those who have been feeling the pain, is those that were buying bonds. I think early on in the pandemic, early on in the pandemic aftermath, I should say, I didn't think inflation would tick up as much as it did. And I was long bonds. Then Ukraine happened and I completely exited that position because I was like, oh my God, right, this is really going to cause issues with energy. And so it did. Many people were still buying bonds. And I think that was really, really painful considering the extent of interest rate hikes. And you can view the pain trades because of how volatile or how much velocity the move has behind it. You know, it moves very, very quickly. Even recently through November, the selling of the dollar has been very, very strong. But now we're probably going to see a reversion of that because lots of people have gotten long really, really quickly, got all their stops, lower in the market. And so the market now is saying, okay, there's a slight regime change or something's changing. Let's go and take all of them out. So that's exactly how it works. It works on a cascade basis. So people who have got their risk limits in the market, they then get absolutely bulldozed through. And it explains actually quite a lot of the anomalous returns, specifically in FX. There's a paper on this. I can link the paper if requested. But there's a paper on this that talks about the greater than 3 standard deviation moves in the FX market and how stop loss cascades contribute to this. So always pay attention to the pain trades because it's key for where the psychology of the market really, really changes. After pain trades, you see exhaustion, and that tends to be where the regime is changing.